Everybody's asking the question about whether we'll see a Santa rally in markets. This usually happens between the 14th and the 16th of December and traditionally runs into January. The question is, does it happen during bear market years? That's what we've faced in 2022. Hello, ladies and gentlemen, and welcome back to a special weekend edition of the Markets Around the World. In today's video, we take a look at the 3 gap scenarios that are most likely over the next coming weeks and months. And we also talk about the elephant in the room, the huge rejections and trap zones that we most likely saw happen to dumb money last week. What is happening with smart money right now? We've got the answers in today's show. Well, welcome back everyone to the Daily Show here where we talk about markets around the world. If you like stocks, if you like cryptos, if you like commodities, then of course subscribe, smash the like button and stick around because we've got the news headlines, the macro, the lead indicators, and the key levels that you should be watching in the markets for the week ahead. So the stock market has now moved from everybody being talking about inflation to now it's the fear of recession. I mean, it's just so funny how these news articles are written, yeah? And it just shows you time and time again why you need to be able to see the forest from the trees and you need to make your own informed decisions with the key levels of confluence at hand. Let's talk about one of those. And of course, come and follow us over at FX Evolution on Twitter if you're interested in seeing some fire memes. And on top of that, of course, some great information. Smart money versus dumb money. Let's take a look at the charts because this was an interesting uptick in dumb money that came in right through that inflation number. We basically saw a huge spike come in here and the line chart doesn't really show what happened. It actually went above the previous high and then rejected from that point. What happened at that point? It looks like dumb money inflow was increasing at a fairly fast rate. This is not what you want to see if you're long in markets right now. Now, if you're short or if you've been thinking about short or you've been looking at that, and that's, of course, what we've been talking about here on the channel, you probably celebrate those types of events because it means that, unfortunately, many uninformed traders and investors were sucked into a rally around that inflation figure. Now, we know that inflation most likely is dropping. In fact, when we've seen inflation drop in the past, it's tended to follow through. And the market's already realistically figured this out, and it's already predicting that things are going to improve. But do remember that it's all about where inflation is going to be. At the moment, we've reported last week that food and rents are the biggest problems. These are where inflation is actually staying, let's call it sticky. And these can cause stagflationary style economics and markets. And this is going to be a big problem for the Fed. Now, obviously, the Fed says it's following other figures, but realistically, look for food and rents in 2023. If they remain high, it's not good for the market. Expect things like energy, utilities, used cars, all of those other parts that go into inflation numbers to continuously drop. So what's happening now with forward projections? Well, of course, the market is starting to price in not only what we call the terminal rate, which sits between, at the time of this recording, about 4.8 to 5%, in 2023. That is the highest interest rate that we expect the Federal Reserve to have to go to. But then they're expecting rate cuts all the way through the back end of 2023 into probably 2024, 2025. Now, Morgan Stanley here actually is predicting faster rate cuts. And most of the reason is we're moving now from, okay, we've maybe stopped inflation to how bad have the economics gotten? How bad are companies going to come in with the first quarter, second quarter returns next year? And remember this figure, 17x PE, okay? That's forward PE. This is a fair valuation on the S&P 500. At the moment, we're kind of around there. If we get downgrades coming through companies, expect us to always be at 17. And if you ever get a standard deviation away from that, as Buffett says, that's a very interesting time to be looking at the market as a fearful market and potentially looking at some type of opportunity or at least DCA or something else around that time. You obviously make your own decisions at those periods. Let's move over to gold and crude. Now, what's going on with gold and crude? Well, it's an interesting fact that when gold and crude tends to start spiking, that is the ratio, we're already in a recession or we're about to come into a recession. This has been pretty common over the last decade, you would have to think, and over the last realistically 30 years. And this is something that's just started to spike up now. Gold is becoming one of the better asset classes, as we suspect it will probably be one of the better assets in 2023. And crude oil has been a shocking asset in the recent months. So ever since it really hit that 129 to 130 area, so 120 plus a barrel, we kind of thought it would go weak. It has, and we still expect it to probably hit 65 a barrel in the coming weeks and months, and possibly even just start to realistically trade in a sideways pattern. So crude oil could be something that you want to have on your charts. And if this starts to spike, it's often a good precursor that yes, the recession's coming in, and at the same time that silver and gold are going to do much better. One of our biggest negative kind of claims on the market recently has been this one, which is the MACD switch with the 200-day moving average going down. So this is where MACD has crossed below the zero line from overbought with a declining 200-day. The stats are not good for the next week, the next 2 weeks, even up to the next 3 to 6 months. And remember, we're only about a week and a bit into this stat so far since it's happened. So it shows us that we need to expect volatility and kangaroo style markets ahead. And we'll be talking about our pretty much big 3 case scenarios as we move forward through today's video. Remember, in 2023, it's all going to be about food. It's all going to be about rents. These are the 2 main sticky points of inflation. There is more to it than that, but don't expect inflation to probably be anywhere near as high as it was in things like energy and utilities and used cars, especially used cars. They're going to just continuously drop like a rock. If I was to predict it, I would think that's one of the markets that will be hit the most in early 2023. Conditional seasonality shows us that most people shouldn't be expecting a Christmas rally. So we asked that question at the beginning. A lot of people have been sending it through to me. And as we've said consistently, during bear market years, we don't tend to have that December 15th, 16th kind of hike. Now, traditionally that has been how the markets have worked, and I've loved the Santa Claus rally, but the stats don't support it during these bear market kind of years. So it still could come. Obviously, it's stats are stats, but this is where we tend to see the market turn bullish. And I have a little bit of a theory about that I'll share with you later on in today's video. Let's move over to defensive versus growth style markets. Remember, the S&P 500 is made up of 500 companies. Inside of those 500 companies, we have defensive styles, we have growth, we have hyper growth, we have all sorts of things. So what's been doing the best over the last month? Gold, utilities, healthcare, genomics, and of course, staples. This just tells you the market has already been going defensive for a while, and we sniffed this out quite a few weeks ago. So if you've been following along, you'd know I'd been making a big deal about the market moving defensive pretty much about 3 to 4 weeks ago. Let's move over now to the charts, and we'll start off here with the VIX. This is the volatility index. So it was a pretty decent weekly close for it. We've just gone through one of the most volatile periods. Of course, this was trillions of dollars of options expiration, the inflation figures, and the federal and many other central banks actually hiking rates across the world. We've got to talk about maximum pain. I'll do that later on today's video just so that we can explain probably what's happened there, because a lot of people were expecting it to hit perfectly. I think they did a great job, but we'll talk about it later on. So the VIX here spiked up, and this is pretty traditional with what we've seen previously over here. We probably like to see maybe a bit of bearishness over the next 2 weeks if we were expecting follow through of a higher VIX. Now remember, 35 plus usually will not be achieved on the VIX unless you make a new low on the S&P 500. So it takes a lot to get the VIX really excited. And part of the reason of that is because it's already been in these zones before. The market expects it. It's not like something to be incredibly fearful about. Let's take a look at yields. Yields actually dropped on the Friday session, even though the market was dropping as well. Traditionally, we've seen kind of the US dollar usually going strong in 22. We've seen yields usually going up on down days for the stock market. We didn't see this. I think they are disconnected at this stage. And I would expect that pretty much for 2023, it's going to be a fight between the US 3-month. So something you might want to do is put on US 03MY versus US 02Y and check that into your TradingView charts. And this I expect to continuously become more and more inverted. And that's because the movement between the Federal Reserve and where they're going to be with rates and where the market believes the damage is being done to the stock market is going to be very severe. So this, we've talked about it for a few weeks now. We expect that to continuously go up and up and up as the Federal Reserve moves towards its terminal rate, holds it there for as long as they can, and then of course starts dropping. All the meantime, the market's going to be going quite sickly, saying we need more cuts and we need them now. Let's have a look at some of the other lead indicators that we've got in charts. And of course, one of those has to be high yield bonds. We've seen high yield bonds precursor bigger crashes before. And when high yield bonds have been going poorly, it's been bad for the markets. This was a shocking week for it. I mean, look at that shooting star style close. If we do get rallies, we have to expect that at this stage, it looks like high yield bonds are not in focus. And let's compare that with LQD, which is corporate grade higher quality bonds. Look at the difference here. So what this is telling us is that although the forward yields believe rate cuts are coming, which is good for bonds, they're thinking at the same time, I'd rather own corporate grade quality or TLT versus high yields. Speaking of TLT, in a bit of a consolidation pattern here, everyone started talking about this trade. I think we still like it for the medium to long term. This is treasuries. They tend to do really, really well when rate cuts are expected on the time horizon, and they're usually seen as a safe haven. So they're still very, very low, but I'd love to see them kind of do something like this, go into that green box, and then maybe pick up off that. We'll find out. Time will tell. Let's move over to the US dollar. Remember, our expectations is that the US dollar has most likely partially disconnected with risk on and risk off in stock markets. Do expect something like that to continue through 2023. And let's have a look at kind of, I guess, the elephant in the room. And that's going to be somewhere around where we are at this stage. We're in a very bad trajectory for the US dollar. We know the US dollar made a new low and it spiked up. And we expect it to probably continuously find a little bit of strength here. But have a look at this. This is the current downward trend. It's not absolute, but you can see that it's making a series of lower highs or lower peaks and lower troughs. For the US dollar to really strengthen this week, we're going to need to see it break these two key zones that we have alerts on, 105.24 and 105.88. Those levels will need to be broken. For other players out there, you would have known that once it broke through here, we believe that there are some bulls that are recommitting themselves to the US dollar at this stage, and that's just more of a short-term vision. So I'd like to see the US dollar probably strengthen and further find some strength up to these key levels and find out whether the bears control those zones yet. Watch the US dollar. The key is probably going to be to more likely trade things like gold and euro though. Let's move over to gold and have a look at that one. Here's the weekly close for it. So we have a long leg doji followed up by a long leg doji at the most traded level over the last 3 years for gold. This is a phenomenally important zone for these metals. And let's have a look at the 2 hour here, just to get a bit of an idea about what gold actually did. So first up, it broke through these series of higher lows that we saw happening on the market. We then saw a nice little base formation and it came back to the first level of problems, which is around 1795. We've thought for a little while that it may continue to spike up. So what we might see is actually gold strengthen into this level somewhere around this 1803 and then potentially find weakness there. And if that happens, then we get a new low. Think about what this is. Here is effectively a UT or a UTAD breakout from Wyckoff's idea of distribution. We would then have the buyer's climax. We would have, of course, an area caused by inflation, which you'll see through so many technical charts today, that's trapped people into longs. And then that final kind of rally met by sell demand that shows us that gold might need to weaken for a period. We're still bullish on gold over the long term, that is over the next 3 to 6 months. But realistically, I wouldn't mind it to do something like this before that happens. Let's take a look at silver as well, because a lot of you have been getting very, very bullish on silver. And I think silver presents probably the best double case and one up for the bulls. And this is over the medium term. I think you've got issues in Peru. There's a lot of silver mines over there. But on top of that, look at the base formation here. That's a classic accumulation base. We've spoken on and off about this for months now. I do think that basically any bigger pullbacks on silver should be met by bull demand. And that's because we're either entering into stagflation or we're entering into a time where the interest rates are going to be cut on the forward. And that tends to do well for silver and gold. Don't ask me why right now. It would take me about an hour and a bit to explain it. But realistically, yes, contrary to popular belief, these are not inflationary style metals. They tend to do better in stagflation, and they tend to do actually quite well when rate cuts start coming back through. So those two things are really important there for those metals. And silver still has one of the best bases going around in markets right now. US oil did sell exactly off that level. You can see the trend line that we had drawn. And this was the reason why. We had this sneaky little, what probably was a bunch of orders, supply zone in here, drop, base drop, came back, made a little sneaky high, rejected, and continued to sell off. Now that it's gone underneath this zone through the Friday session, which sits around 74.88, you'd have to think that oil is starting to present itself as continued weakness. We even get this nice big rejection that comes off the turn here. And it looks like oil might want to go back down possibly to the 70s or even start to make its way towards $65. A lot of this has to depend on whether the stock market freaks out and continues to sell. But yes, watch oil. It's currently in a very strong downtrend. And this was another nice level for shorters. Very consistent, had a lot of reasons to, of course, dislike it. If you're feeling bullish on oil, that's your level for the week ahead. You need to see this thing break through 77.80. Once that occurs, you're thinking, okay, looks like we've snapped that kind of low and we're looking towards further rallies for oil. Great level, certainly important to watch. Let's move over to the elephant in the room. Remember, Tesla was set for 150 puts this week, and we had all those 190 calls coming through as well. Now, this was another bad week for Tesla, and it's been pretty shocking. Could Tesla go lower? Well, I've thought for a while that Tesla should go to 136 to 123, and no one likes that call. No one ever liked that call, but that was probably the strongest feeling I had. And the main reason has to do with the negativity around the stock. You've obviously got Elon buying Twitter, Elon selling tons of Tesla to support that. That's never great. The market hates those types of things. And just overall, a huge amount of bullishness through these two levels from retail traders. Now, I will say this. Bullishness has turned into bearishness from many retail traders. And I do feel that we're starting to get into that zone where Tesla may have run ahead of itself. And we saw it the other day where we had the markets going lower and Tesla actually rallying. So we're getting into that area where we're not quite in capitulation, but we're certainly seeing a huge amount of negativity. And I'd like to see it fill at least this gap at 136 before we see base. Traditionally, when I usually look for stocks like this, I like to see this type of thing occur. And once that happens, then I can say, cool, now we're looking for a nice accumulation turnaround style story. And you'll notice that most of the time, markets actually tend to base. And while you won't get the best price, you get a way better informed decision about the lows when you get those secondary pullback, which tends to happen a lot. Even over here, it went up and it came back to give you that valuation again. So we always say patience, react, don't predict. In this case, if we were selling, we would be thinking there's probably still a little bit more to go, fill the gaps, and then find out whether we can create a base here to allow that rally to come through. Do remember, although it's not that close, earnings is around 38 days away here for Tesla, and this is going to be the biggest blockbuster earnings we've seen in some time. 2023, mark my words, is about valuations. Recessions equal valuations. It's very, very likely we're already in a recession. That's going to become very important when we start talking about whether these companies are even worth what they're worth. Let's move over to Apple. Now, this is one that we've been using, Apple versus the SPY. It shows us whether the strongest stock in the world is actually still strong. Notice the breakout that we got over the previous week, not good for Apple. And this tells us that effectively people are starting to sour on Apple and it's not looking so good. Let's look at the break and just think about where we ended up finding ourselves as of the close on Friday. So first up, we made a new low. Notice that new low was instantly partially rejected through the Friday session. My suspicion is that markets may actually have a little bit of a rally here and do something like this or even like this over the next week. I did think that may come through on Friday, and we'll discuss that more, but this is a stock that had those lower highs in. We did a great job together as a community figuring out that this thing was weak as hell, and it's continued to look pretty bad. Let's put it in perspective on a weekly just to show it. There's the closure. Notice the closure is underneath the wicks, or at least it's at these lows. That means that usually rallies should be met by sell demand. It doesn't tell you that there's strong buyers here like there was last time. So if Apple starts to crumble, that takes the rest of the market with it. Of course, this one here is 39 days away till earnings. There's a lot to go into that, but I wouldn't be surprised if markets sell the rumor and then buy the fact. That is, it's a sell-off into earnings, concerns about earnings, concerns about everything. Imagine this dialogue in the news. It'd be so fantastic. Yeah, they'd be like, wow, the world's ending. And then all of a sudden you get the earnings. Oh, it's not as bad as we thought, but and then all of a sudden it goes up. Remember, look for this in the big stocks. It tends to be that Apple and other big tech stocks have buy the rumors and then sell the fact into earnings. And sometimes, very rarely, it's sell the rumors and then buy the fact. Will it be that way? We'll look at it. Let's take a look at NVIDIA and look at all of these case scenarios. First up, shocking close for NVIDIA. That's really bad. That's a shooting star coming off, literally hitting these top ends. This is a very good profit zone for a lot of NVIDIA bulls. I love this stock, but yeah, that doesn't bode well. It's a bad close. Here is the kind of downward, or that slight grind higher, and you can see there's kind of like a trend line that's coming through the back here for a stock like this. But I just want to look at semiconductors. This is the one that we really discussed. We discussed the false break that we believed happened during the inflation number. We've now seen a new closure low, not quite a new low, but certainly a closure low. And you have to believe that at this stage, you're looking for a series of lower highs. So kind of like fill the gap up to here, then movement down, move at least to what you would suspect is the gap fill, which is from the previous inflation number over here. This looks like distribution. It's happening, and it's happening across so many sectors. Here's an example of XLF. Financials made a new high, trapped people into longs, rallied down. We were probably one of the first ones to discuss this here together on the channel. We expected and saw the rally that was instantly met by sell demand, and now we find ourselves here. If we rally, we probably find sellers. It's not a good look, and this is the most important, one of the most important sectors in the market because it's financials. So there's still gaps that could be filled. Got to be very careful here with how it ends up looking on the Monday session, but certainly pay some attention to it. Let's look at XLY. This is consumer discretionary. Again, almost new lows here for discretionary. Look at the rallies. Look at the current potential here for distribution. Drop, base. What if we drop again? What if we go the same distance? Let's work that out. If we take that distance from the move, often these can be similar, either from here or even from the break. That pushes us down to some serious lows, 93, 94 type scenarios on XLY. And if that happens, then that will really, really put a huge amount of pressure on the markets. So be careful here, guys. You can see what's at stake. Look at the weekly close. Previous times we got here, we found buyers. That was not the case this week. It closed near its lows. What if the market was open for another 10 hours or 20 hours? Always ask yourself that question. Here's consumer discretionary versus staples. A new low absolutely confirmed here on the markets. We've followed this now for months and months and months, and it's helped us to really say these rallies have been mostly false. We haven't liked them. This is not good. It shows you that the American consumer, which is 1/3 of the US economy, remember 2/3 of services, is sick. And we're seeing that represented on a chart here. It's not very good. Let's move over to the DAX. We'll just load up the DAX here. And first up with the DAX, we'll notice that it did pretty much what we thought it might do, which is have problems with this supply. Quite a few of you in the comments were short DAX. I guess you're probably pretty happy with yourself now. It took a new high. It didn't get past this one, and it sold off. Rallies, you would think, should be met by sell demand. Here's the supports that could become resistance as we rally through, but that is clearly distribution if ever you've seen it. And if you go over it, there's a massive distribution that we spoke about a lot at the start of the year, which actually led to those further crashes around the world. And this was just a classic case of where we saw lower highs. And remember, we ended up getting a rally to that level and then sold it off again, which we talked about a lot. So this is actually a real scenario and quite possible across most of these markets. Let's move over to the Dow. Very similar, shocking looking candles. Let's look at the daily again, making a new low. The Dow's not the sickest looking one. It's been one of the strongest. coming into maybe a little bit of a support level for an initial rally or spike. Let's look at the probably one of the best markets that you've ever seen, which traditionally has been NASDAQ over the last decade. Does it look the best anymore? Absolutely not. Terrible look. Comes into the downward trend line, rejects through that inflation number. We end up getting a huge rejection wick, which we spotted and talked about. We end up getting the new low. You'd think that rallies are met by sell demand. I mean, I'm not really trying to be super negative on the markets. I actually find the idea and the prospect of opportunity in 2023 to be amazing, but you can't like these. I mean, this is not something that you sit there and you go, oh yes, that looks fantastic. I'm so excited about buying it, because I just don't think you can be when you see traps like this set. We see dumb money inflows and everything else. So again, weakness here on this market. Let's have a look at the 2 hour. What we suspected was that we might see some strength on Friday due to the maximum pain, which we'll speak about in a second. But I would like this level to be broken if we're going to see some initial bullishness. So this is the 11,000, basically 400. And my suspicion is if we can rally up, do this, we would probably move somewhere into the 11.8 area. And I think that will suck in a lot of buyers in around here. And then we might move down to eventually at least clean up that 10.8 gap that we have on the NASDAQ and the Qs. A few of you have asked about the Q levels, so I'll bring it in here. This is a big request that I always get. Do remember it's the same thing. You just need to realize this is the exchange traded fund. So it looks the same. Obviously there's gaps in here. So what we're talking about there is realistically trying to fill this gap. So remember the gap from the close, there it is sitting at 286. So we're hoping that the market will rally, fall, rally in to the 286 before it makes this gap close down here. Of course, it can still just go straight into that. We don't know that yet. And if we do end up getting this, I'd love to see that, because that would further trap people into longs. It would also put a lot of pressure on this zone should it come down, and maybe even open up that further capitulation zone. Let's look at the S&P 500 to talk about the three main levels that we've got moving forward. This is the S&P 500. So we've got the 39.94 gap, which is now unfilled. We've got 37.50, which has been our base case scenario of market pullbacks. This horrible wick, by the way. And then we have 35.83, which is left behind from the previous rallies. So if we just zoom out the 2 hour here, you can see the gap never got filled. So we have one down here, one here, and one here. So which ones get hit first? That becomes the question. Well, it's all got to do with realistically how this next part plays out. If we get that rally, then we bust these kind of highs, pull back into the long would make the most sense. And I favor that one the most at the moment. So many people will want 37.50. So if we just bust down to 37.50, between 37.50 and 3700, and we'll do some further videos on this, is a super, super strong level. So this area, I would expect buyers to probably come through if it just keeps dumping in. These are the main two at this stage, but we need to keep the dark horse in here, 35.83, still very real, and a massive gap close that never got filled. Let's talk about this structure though, very weak. We'll use the futures market to just show how bad it really is. Look at this. So we have this potential buyer's climax again, false break, which we talked about. It looked really nasty. That was the inflation number. And it went all the way up really quickly, dumped. Then we had the FOMC, the rate hikes, of course, hawkish Fed, all of these types of things going on. And then we just saw further sell-offs. So the elephant in the room that a lot of people have been asking me is, why didn't we get 392, which was the max pain level? Max pain is only a concept of where you make the most amount of money. Let's just detail this. We know that 380 had huge amounts of puts on them. Did they get paid out? No. We also know that 420 had huge amounts of calls on it. Did they get paid out? No. We had 4,000, we had 390, and they were the main kind of subsections. And I reported all of this over on the Twitter at FX Evolution. In fact, I think I actually did a quick draw up. So let's have a look here. We'll scroll down and we'll go through it. There's the levels. So these are the main key zones. 392, of course, was a possibility, but you do need to remember there's 6 million and $4 trillion at stake in these markets. Throughout the day, it will have switched as well as people close their positions. So really anywhere in this zone is lobster lunches for Wall Street. You can trade towards max pain if you wish to. You can use things like butterflies and stuff and you close them before. But yeah, realistically, I probably did expect this to be occurred. It didn't happen. Doesn't always have to. It's only one piece of information. Very important. You have to bring together as many reasons, not just one, as many reasons as possible to make an investment choice decision. So that's going to be really important. So at this stage, we kind of focus on the key little lower timeframes. And if we look at the lower timeframes, we've got a couple of key levels. First up, we saw the rally come through here and it dropped off this area. For anyone in the private community, you'd know I was talking about that leading into that session. We also have this 39.10 zone, which was that previous support. So I really favor, even though these look horrible, I favor this idea that potentially we might market move up, break 38.80, and obviously we need to break 39.10, then potentially dump, then rally into filling that gap. That is the 4,039.95. Now, if the market doesn't do at least these rallies, which show us that it wants to therefore do this, at this stage, it's just negative, negative, negative. We got a huge distribution and that pushes to the 37.50. Remember, have the patience to react to the market and then have scenarios where you believe you have edge. That's what's key. We know not many people got filled here. We know there's orders that need to be filled on the way down. So this level around 37 to 37.50 makes a lot of sense of being hit over the next couple of weeks or even couple of days. At this stage, there's nothing to say that the bulls are back in town on this market. It's just a suspicion about trapping more players. And if these levels get hit, then we know, hey, there's a good statistical chance at these points. Let's move over to Bitcoin. As we suspected, it continued to falter and it actually made a new low. This is not good for Bitcoin traders. And you would have to think that now, again, rallies are met by sell demand. We have a high, a low, a higher high, and a lower low. So we're thinking that rallies, maybe 17.6, something like that, could be met by sell demand. Take a look at the 2 hour here. Again, that 17.4, 17.6 level would make sense. It doesn't look good. I mean, Bitcoin looks shocking. The market looks really weak. And most things look like they want to turn to the downside. For the week ahead, in terms of earnings and data and all of those types of things coming out, it's a lot quieter than usual. We have the Bank of Japan press conference here on Tuesday, and monetary policy coming through as well. This is all New York time. And then we find here on Wednesday, CB consumer confidence, 10 a.m. New York time. Then we scroll down and we've got the core PCE price index, which will be probably the bigger bit of data this week. And that comes out Friday, 8:30 a.m. New York time. So do expect that there could be maybe a little bit less Christmas spirit than usual. The data, the stats kind of point towards that. Obviously, everybody else isn't pulling just bear market years out. They're just saying in general, we get rallies. You'd be correct. Rallies are one of my favorite. It's actually one of the most consistent favorite periods of time to be bullish in markets. But that just doesn't seem to stack up with what we've seen so far. And even if we do get rallies into the end of the year, it just doesn't look very strong. Let me know what you think in the comments down below. Subscribe, smash that like button, and thanks so much for watching during 2022. Bye for now.